You do the venture studio thing. Walk us through what the economics might be like. Is that a founder comes to you with just an idea and then you co-found it essentially with them? You're both equal partners, or do you negotiate it every time? And then we'll go on and tackle that signaling issue.
Sure. So, it definitely varies based on where the company is in its progress. We definitely have co-ownership in certain businesses. So, for instance, we're working with a founder based in Australia who has been developing an app with us for over 2 years. We provide engineering, we provide capital. He's providing his skill set and capital engineering, and we co-own the project. So that's a 50-50 ownership. But in most cases, when people pitch us projects, they're at some level in their journey. Either they're at the very, very beginning, or maybe they're already selling, or maybe they're either at scale. And we end up, owning a portion of common shares that might be at the low double digits, right? We almost, honestly, I can't even think of the last deal where we had the majority ownership into anything. We're always going to be low double digits. And part of the understanding is as they work through that studio, the fund will begin to invest. So over time, our position as common shareholders will get diluted. And basically we work with them on the capital need. And then we typically deploy, million to, up to $10 million into an individual deal. So we become very long-term partners and, with these founders.
How do you make that determination after you've done the year of work to get this app up and running to then put venture money in or not? Because maybe your LPs would be like, hey, are you going to say yes to everything? And when you say no to something, how do you decide to say no? And then what happens to that company? Does it shut down, or does it go to another firm? And then how do they explain, I don't know, to another venture firm? They go down the street to our friend Mark Suster at Upfront, and he says, oh, Mike, why didn't you invest? I guess it's not going well, or what's the issue? How do you deal with that signaling issue that the Scouts program had at Sequoia as well?
Yeah, it's happened kind of in 3 different ways, right? So one is that the company becomes profitable, at really, really early stages because they're in commerce or services. And at the end of the day, it's really not a venture investment. They're generating capital, they become break even. It's going to look more like a lifestyle business, and we don't think it can drive venture returns.
Define for people in the audience who don't understand the lifestyle business versus venture returns, what that means to you and in terms of numbers and practical reality.
I mean, it depends on the market segment, but, we can pick on commerce for a second. So, very few commerce companies that we're involved in, whether you're making a product or a service, very few commerce companies that can't exceed, call it, $20 to $50 million in revenue will ever really be worth a lot in the market. Right. So if we're touching a beverage company or a service business, we need to believe it gets to hundreds of millions of dollars in revenue in order to drive, a fairly substantial return. But there's definitely commerce businesses we've worked with in the studio that'll probably be a great $2 million a year, $5 million a year business that'll support a nice little founding team. Maybe they'll throw off a little bit of profit every year, but at the end of the day, they're just not going to hit that next level of scale. Whereas in that case, it really wouldn't be appropriate for our venture fund because the venture fund won't drive the kind of returns the venture fund would need.
Got it. Okay. So that's scenario 1. And you said there were 3 scenarios. So thanks for explaining that. Yep.
So scenario 2 is really where either between the market, i.e. the competitive force of the market, the unit economics of the businesses, or certainly the personality of the founders, it's just not really going to be a business that we want to pursue, right? So that could be that, we had a really interesting business in, education technology. By the time they got to market, there were so many competitors. It was clear they weren't going to be able to break out. We didn't think they'd get to scale. The founders started having challenges. And suddenly for us, it didn't look like a great investment. I would argue it probably wasn't the right investment for anybody at that point. Now, we had already invested some capital, but when it came time for us to really decide whether we were going to deploy more capital, it just ended up not being the right story. And in their case, other venture capitalists aligned with our view, not because of us, but as they went to the market, no one else, saw something that we didn't see. Everyone kind of saw the same thing. And those founders went off to go do different startups. And sometimes when that happens, they come back to us, right? And we do different startups with them. But in that case, it was just for whatever reason, the startup didn't work out.
Okay, so you have number 1, it's not going to hit venture scale. Number 2, it's not clearing market with other investors, and it might just be a failed experiment at this point.
That's right.
And that's nobody's fault. And then the third one, and that's an uncomfortable conversation. Mm-hmm. But it's not a horrible conversation because you're saying, hey, go get a term sheet and come back to us. And if you can't, well, that tells you everything you need to know.
That's right. Well, and I mean, and I don't know if you feel this way, Jason, but in my perspective, a lot of these founders, I believe at some point in their career, they actually probably will be successful. So a lot of time my discussion with them is saying, look, this business may not be the right business for you because of all these other reasons. So the sooner you stop doing this business and you try another business, you might actually get closer to that moment of success.
Yes.
So in many cases, I'm like, look, you need to be okay with us saying this wasn't the right idea, but immediately let's go try the next thing and next thing. And if you want to try it with us, I'm super excited because now I know you and we're excited about building stuff with you. So I'm really actually okay if we do that through a rapid succession because we save people a lot of money. We save them a lot of time and hopefully they get closer to whatever is going to drive their success.
But founders are not always that quick to realize it.